Welcome to the Dear Rochester Retire Well podcast with David Pulcini from 6 Point Financial Partners. In this podcast, find your path towards a brighter financial future with David as your guide as he helps individuals, educators, and healthcare professionals explore ways they can build wealth while minimizing risk using a multifaceted, comprehensive approach to personal finance. Are you ready to take the first step towards a brighter financial tomorrow? Let's get started.
Ladies and gentlemen, thank you for listening. I just received notice that we've reached a milestone for listens or downloads that I didn't really think we would ever hit, and I'm very grateful for that. So I never had any goals for this podcast. Our firm never had any goals other than getting out information that our clients, our friends, maybe other advisors, and really hopefully anybody could benefit from. But when you have a podcast, you can see the numbers. I don't know if folks know this, but you can't tell exactly who is listening unless we hear directly from you. So I've been saying this a lot recently, but if you'd like us to cover a topic, just reach out and I'll see if it makes sense and we'll dive into it. I have to add the if it makes sense because if we have had some really interesting requests as well that we cannot talk about on a financial podcast. So I'll share those later. But today we do have a special one. A gentleman that I've known for quite some time and some years has asked that we go over annuities. And that is a topic that I can talk about all day. I don't need a guest for that. If this is popular or people want to get more into it, maybe I will have a guest on that specializes in annuities. But for the gentleman that requested this, I thank you because I am not sure how I have not done this yet. Okay. So annuities, folks, what is an annuity? When you hear the word annuity, what do you think of? How much can you take out of your current investments and never run out of money? When is the absolute best time to take Social Security? Are you 100% confident in your investment strategy? Are you paying too much in taxes? Why? If something were to happen to you today, what would they find? If you are doubting any of this and would like a second opinion or to review these items, along with many more, feel free to reach out to us. You can visit us at www.6pointsfp.com or email us at info@6pointfp.com. Back to the show. Maybe guarantees, maybe interest rates, maybe insurance companies. Maybe you think nothing and you've never heard of an annuity before, and that's okay. But an annuity is defined as this. It's a contract between you and an insurance company that requires the insurer to make payments to you either immediately or in the future. You can buy an annuity by making either a single payment or a series of payments. Okay, that sounds like a lot, but basically we give money to a company, they give us some money back, or they pay us based on our lifetime or something like that. I wish it were that simple, but to add some complexity to this, there are many types of annuities out there. There are fixed annuities, variable annuities, fixed index annuities, immediate annuities, and deferred annuities. I hope I haven't lost you yet. Hang in there because I think this will be beneficial. But a few of them are simple. Okay, a fixed annuity will pay an interest rate, usually based on the interest rate environment that we are in and based on the length of the contract. For example, a 10-year annuity may pay 6%, where a 5-year annuity, shorter time, right, may pay 5%. And a 3-year annuity might pay 3%. It's a lot like a CD, just with a longer maturation, typically becomes a higher rate, right? Just like a CD. Another simple annuity might be the immediate annuity. You give a company, I kind of described this before, a lump sum of money, and then they pay you based on rates and how long you are supposed to live. Okay. There are options that you can take for beneficiaries, but we're going to leave that for a different time. But let me give an example here. If you were 60 years old and you put $250,000 into an annuity, you might get $1,500 per month. Okay. 60 years old, $250,000, $1,500 a month. If you are 70, that might go up to $1,800 a month. If you are 80, it might go up to $2,500 per month. They give you more per month the older you are because you are not supposed to live as long, and you won't live as long technically, right? And that's it. Okay. That's based on interest rates, age, and the dollar amount. So some people are thinking, why would I ever do that? I lose control of my money. And others will say, wow, a guaranteed income with no stress about the markets, that would be great. Okay. And that's why these products and accounts exist. These annuities are the boring ones, and that is not why we are here today. Okay. We are here to discuss the flashy, the fun to think about, the glitzy, extravagant annuities that show you getting insanely high guarantees with little to no downside. Okay. Here's what I want to do for the next, 5 to 10 minutes. I want to tell you, the listening audience, how I would quote, sell you an annuity if I were one of those advisors. Okay. For the 5 to 10 minutes afterward, I'm going to pick apart the guy who's myself, so I can do that, trying to sell you that fancy annuity. Then I will explain where we believe annuities may be a good fit for certain folks. And I will also share how advisors get paid on these products, which is not typically talked about. And folks have no idea how we get paid on that. And I think it's really important to know. So I do want to warn you, the first part of me selling this annuity will probably sound really good. Or actually, maybe not. I'm not much of a sales guy, but I'll try. But it's going to sound too good to be true. And here's my disclaimer. There is so much wrong with positioning an annuity this way that I will feel guilty about doing this. But most people within 5 minutes of showing this type of annuity or how I'm going to show it may think, wow, this sounds way too good to be true. This is amazing. Why isn't everybody doing this? And that's actually my point. Okay. Beware of this advisor. All right. So my made up prospect name, the made up person who's going to be buying the annuity from me, hopefully, if I can sell him on it, we'll just call him Scott. So here we go. So Scott, hey, thanks for taking the time today. I took a look at your statements and I've been thinking, based on your overall financial picture, are you worried about the markets right now? Yeah, me too. How about inflation? Of course you are. Everybody we meet with is right now. And just so you know, Scott, another common concern we run into is folks that are worried that they will outlive their money. It should be a common concern. Is that something you've thought about? Yeah, I know. You've had some serious longevity in your family. What about taxes? We are currently still in a historically low tax rate environment. Do you think taxes are going to be higher or lower in the future? Higher. That's right. Okay. We are worried about the markets. We are worried about inflation. We are worried about outliving our money. We are worried about taxes. Would you agree? Yeah, your words, not mine, Scott. Let me show you something that people have been investing in to really try to reduce the risk of these outside forces, because these are truly outside of our control. But if we can control some of this, your retirement picture will look drastically better. Does that make sense? I thought so. Okay. So I'm going to show you two investment options. Option one here allows us to put a 7% guarantee on your money while still being in the market. 7%. Let me show you how this works. So you put $500,000, I'm making up a number, into this investment, and it grows at a minimum of 7%, or the market growth, whichever is, Scott, what do you think? You get the 7% or the market growth, whichever is lower or higher. Yes, higher. So you get 7% or whatever is higher. You cannot get less than 7%. It sounds amazing, right? So what we typically can do is be really aggressive with these accounts because we know we're going to get the 7%. If the market drops, we get 7%. If it takes off and we gain, let's call it 20%, we get 20%. And the best part, that locks in. Now we have a 20% gain and the 7% starts back on top of the 20%. Is this making sense? How do they do that, you ask? With rates rising, these investment companies have needed to stay competitive. So they've gone from the 2, 3, 4% up to 7%. And this is good for 10 years. So how does a minimum of 7% with unlimited upside for 10 years sound? Yeah, too good to be true, right? That's what everybody says. So let me tell you this, Scott. Companies don't offer these rates for long. They will keep it open until they feel they have enough assets added, and then they'll most likely lower the rate again. Okay. I'm just one advisor in Rochester, and I can tell you we've added tens of millions just locally. So I'm not sure how much longer this will be around. Do you want to think about it? Okay, great. One last thing about this account, Scott, I want to tell you is when you take your money out, your first check, if you take it as an income, your first check is your worst check. There are so many ways to get a raise on this. Your first check will be your lowest. Okay. Does that make sense? All right, great. So that's option one. Another option out there right now is a buffered strategy investment. I know, don't worry about the name. All that means is that you can put money into an index. Let's pick the S&P index, for example. There are other indexes we can pick, but let's just pick the S&P. And on the downside, there's a buffer. That's where the name came from. So here's what this means. Let me draw it out for you. Now I'm sketching. You add $100,000 into the S&P index. No fees, by the way. It shows right here. See? No explicit fees. And all $100,000 goes to work for you. Because there's a buffer on the downside, they do limit the upside. So it works like this. And bear with me. This is going to make sense in a second. The S&P goes up 14% without dividends, and the cap is 15%. How much do you get? S&P goes up 14, your cap is 15. Yes, you get all 14%. What if it goes up 16%? That's right, you get 15%, okay? Because that's the cap. But here's the beauty, the downside, the buffer. The company will take the first percentage of the loss for you based on what we choose. Okay, it gets a little complicated here, but we could choose a 10% buffer, a 20%, or even 30%, or maybe some other number in between. Let's pick 20. If the S&P goes down 19%, how much do you lose? If there's a 20% buffer and it goes down 19%, how much do you lose? Nothing. That's right, because the company takes the first 20% loss for you. This is real, folks. What if the S&P goes down 21%? They take the first 20% loss for you. You only lose 1%. By the way, unlike the investments that you've been crushed in over the last 18 months. So they're going to absorb the first 20% of losses for you. And with the markets being down, if you're still concerned, an account like this might make a lot of sense for you. You already mentioned that you're worried about the markets. So either one of these options, option one with the 7% or option two with the downside protection strategy, would really give you peace of mind. You said you're worried about taxes. These accounts are all tax deferred. There are no taxes as this grows for you. You're worried about outliving your money. These accounts can offer a lifetime payout. I'll show you those numbers later, but I promise they're great.
A quick interruption. 6 Point Financial Partners is taking on new clients. If you would like to take the next step in planning your future with Dave or the 6 Point team, please visit them at www.sixpointfp.com to schedule a time or reach out via LinkedIn, Facebook, or simply find us on the internet by searching 6 Point Financial Partners. Okay, back to the show.
So do you have any questions about any of this? Yeah, it's too good to be true. I know. Why isn't everybody doing it? Most people don't know about it, or they don't have someone like me letting them know about it. I think this is something that won't be around for long as things normalize and we get back into normal markets, interest rates. And if we fast forward a couple of years, I think you and I would be really excited that we did this. Okay. So let's quickly talk about diversifying. Okay. Because we still want to be diversified. Here's the diversification strategy. Let's put some into option one and some into option two. That will diversify us. We just need to figure out how much to put into each. Okay. What are your initial thoughts? All right. Yeah, that's a great move for you. Let's do 600,000 into the 7% guaranteed account. And let's do 250,000 into the buffered strategy. Do you have your driver's license on you? Okay. So the paperwork is complete. Thank you, Scott. We're going to get that turned in for you, and I'll keep you updated, and my team will keep you updated. I did mention that not a lot of people know about these strategies and that they might not be around for long. If you know of anyone that could benefit from this, the 7% or the downside strategy, do you mind if I grab their phone number and email from you? Okay. Yeah. It doesn't come to mind. No one comes to mind. That's okay. Do you have your cell phone on you? Yeah. Grab that real quick. Let's run through your contacts. While you do that, I also had my assistant run through your contacts on social media. So I actually have a printout of your friends. How about this guy, Sully? What's his deal? Can I use your name when I reach out to him? Okay. What about this guy, Gabe's? Looks like you guys golf together and hang out every Wednesday at the club. Do you think he could benefit from something like this? Okay. All right, folks, I have to stop. It's the highest cheesiness level I could give, but it's just so bad. Hopefully the part at the end was a little exaggerated and you never experienced that, but I've seen it before and it's so awkward. But notice only after you filled out the paperwork and it was stuffed back into my briefcase did I prove that I was stalking poor Scott's social media and desperate for introductions to anybody that he would give him. So let me back up here. Let me tell you this. The accounts that I mentioned are real. There were no lies in there. I would say just terrible omissions. There was no mention of any of these accounts being an annuity. He called them investments or a strategy over and over again, or accounts, right? He never went over the fact that if you take the 7% guarantee, that might not actually be your money. And this gets really complicated. I'm not going to get into this too much, but I will, to simplify it, I want you, if you're listening and somebody approaches you with this type of account, just ask this. If I want to take my money out and walk away, how much do I get? And make sure you ask about the next 3 years from now, 5 years from now, 7 years from now. Just ask that. If I wanted to take my money and walk away, what is mine? Okay, that will alleviate a lot of this 7% stuff, because 7% is obviously a great interest rate. It's very attractive. So I could see how people would want to do this. Another big omission there was no mention of is a surrender charge. How long do I have to leave my money in these accounts? What if I need it? Did anybody talk about how long it has to stay in there? No. And how about this one? What are the actual fees? Okay, how are they charged? These are typically very expensive products. No one is giving away a 7% guaranteed rate for nothing, or a buffered strategy unless they are making money. The zero explicit fee statement is real. It's on several different companies on the front of their prospectus, the packet that you get. It will say no explicit fees. If you have to explicitly say no explicit fees, then there are indeed fees and costs. Okay. Maybe they're just implicit, not explicit. So what about the tax deferred part? Okay. In most cases, we are talking about retirement money that is already tax deferred. You don't need it to be in an annuity to be tax deferred. Or, not to get into taxes too much on this podcast, if this money is after tax money that is now in an annuity, just be informed the gains are now taxed at ordinary income when you take them. Okay, for example, if you put in $100,000 and it grows to $120,000, the $20,000 is taxed at ordinary income rates. There's more to it. I'll leave that there, but your gains are taxed at higher rates, which, by the way, if you think rates are going up, that might not be a good thing. Or it could be, by the way. So I'll get into that later. But what about this? Here's my favorite part. How much does the advisor make for putting you into this investment, this annuity? I would ask them if they aren't telling you. For years, there were commission-only folks were able to sell this. Now there are fee-based options, and I think those are great, but it's a personal opinion. But commission only to the person selling it. Let me give you an example. If we went with the $600,000 into option one and the $250,000 into option two that we talked about, by the way, to diversify, which is also funny, this sales guy could make a really nice commission. So we put in $850,000 total into an annuity. How much do folks think we make? I could get a check for that for about $60,000 in my next paycheck. Do you think that I could find a lot of people in Rochester, New York that have $850,000 that would love these accounts? Probably. That's real. So I could get $60,000 to put your money into accounts you can't touch for years to come. And in this case, the compensation is not tied to how well you do. It doesn't matter. Once your money's in, I get paid. Good luck. Then we move on to the next person. And we can't wait for your annuity to mature so we can flip it. So if there's a 7-year surrender charge on this, year number 8, I'm calling you back and saying, hey, we've got a better one. Let's put it into a new one. And I get paid $60,000 again. Okay. Flipping is a popular strategy amongst the sales-based advisor. They're great. It's wonderful to have a new commission every 4 to 8 years. Okay. So again, I'm trying to warn the folks here. I'm not going to tie this into a talk on how advisors get paid too much, because our next guest is going to come on and he's going to be covering that with us. But as an advisor, if I could do this, you ready? I could make $60,000 after a couple of meetings with Scott. Or I can put Scott into an advisory account, or a fee-based annuity, by the way, that might pay me, I don't know, $5,000 a year with no strings attached. He can take his money anytime. You can see where this is a huge conflict of interest. $60,000 upfront, one time, I'm not tied to the client, or $5,000 based on a relationship per year. It pays out monthly or quarterly or whatever. I'll tell you folks, most people cannot pass up the $60,000 paycheck. Okay. And many times it's not the best thing for the client. So again, just beware. Another part on this is this. Many advisors will choose to take that big paycheck and they get paid once, just once. By the way, anything meaningful, there might be some small paychecks afterwards. But what if the market crashes? What if the statements don't actually look good? I have overheard in several advisor meetings, this is scary. I don't care if the markets are down. My clients are in an annuity. It doesn't affect me. I already got paid. That is horrible. And that is real, folks. Even if the advisor is not that forthcoming or aggressive about it, the advisor that sold that account to you is probably thinking it. If you put in $1 million into an annuity and I got paid $70,000 and your $1 million turns into $800,000, I don't take a 20% pay cut. I already got paid on the $1 million. Okay. By the way, it also works the other way. If it goes up, I don't get paid when it goes up either. but I got paid once and then I move on to the next person. Just be careful with that. When they say, what the advisor should be saying, by the way, is I don't care if the markets are down. My clients have guarantees that they are comfortable with, and that's why we used an annuity. Okay, that's what they're for. But unfortunately, in many cases, it's not about the client's peace of mind. It's about the advisor. So don't be afraid to ask these questions. My last note on this part, if the advisor that you are working with works at a firm or a company, and that firm or company has their name at the top of the account you are investing in, beware. If I work at company ABC and your guaranteed account, your life insurance, your buffered strategy, or the funds you have say anything about ABC company making the actual account, I'd be asking a lot of questions. Okay. It's amazing how we hear from advisors. Oh, no, I send out the information to hundreds of companies. It just happens to be that my company is the best. Yeah, right. Okay. Is it because they are the best every time, or is it because you get stock options, trips, recognitions, awards, bonuses, a corner office, or even you're just trying to keep your job and pay your bills? Okay. Is it that, or is it because it's truly the best? Because when you, the consumer, buy an annuity from a company that makes the annuity, there's a whole lineup of, quote, partners or pre-managers or managers or vice presidents or senior vice presidents or branch managers or complex managers, regional managers, and more. Yeah, I could keep going on that. In line, waiting for their commission check on each sale. They love when advisors from their company sell you the company product. Ask a lot of questions about that. Okay, please. Okay, so I could rant on this all day. Just be careful of the incentives of the advisor, okay? I'm going to end with this. Annuities in general, and I do believe this, can be great when properly used, okay? They serve a purpose, or they would not exist. They wouldn't be legal. Even the annuities that it seemed I was picking on, they can be wonderful for the right person. That option 1 or option 2, if it makes sense, it could make a lot of sense, okay? So, for example, if you were looking for a guaranteed X dollar amount, X years from now, a good advisor can solve for that and present your options and help you make an informed decision. I could give you several examples on that. If you want $50,000 a year, 12 years from now, guaranteed, no questions asked, you want to take all the stress out of it, here are several options we can use to make that happen. Let's choose the best one based on your situation, if you're married or single, your beneficiaries, all sorts of different factors. But we can use annuities in that case, and they're great, okay? Fixed annuities are a hit right now. I mentioned fixed at the very beginning because of interest rates. And for many people, it's a great alternative to their money sitting in cash accounts in a bank earning 0.1%. Okay. There's also CDs, by the way, that are paying 5 or 6% as the recording of this podcast, but that's for a different day. The buffered annuities, again, when used properly, could really add some protection into a portfolio. So if you want to be in the markets and you want to be in that S&P fund and you want some of the upside, maybe it does make sense to have a buffer. Okay, so they could also make sense. I just want to make sure that you are all asking the right questions and you understand the incentives. And for now, I'm going to stop there. That was actually really fun, getting to, quote, sell an annuity. But my message is this. Know why you are getting into something. And it could be anything. Limited partnership investments, buffered notes, buffered strategies, buffered accounts inside of all sorts of stuff. If you don't know what you own and you don't know why, you should be asking questions. And the old saying is this, and it's so true. If it seems too good to be true, it probably is. And folks, I have done several of these, and when presented in a certain way, maybe intentionally or not, people will say, Dave, that's too good to be true. How is that possible? That is real. If you see that, it probably is, right? So if you're in over your head, just reach out to us at info@sixpointfp.com. You can ask us anything you want. You don't have to become a client. We're here to help. You can find me on LinkedIn or reach out to a true trusted advisor that you know knows their stuff. All right. I'll stop there, folks. Make it a great day.
Thank you for listening to the Dear Rochester Retire Well podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of 6 Point Financial Partners. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Content here is for illustrative and educational purposes only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of 6 Point Financial Partners. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by 6 Point Financial Partners or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, 6 Point Financial Partners, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.